You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we begin, I want to remind you that there's a website associated with this podcast. It's called wealthformula.com. And if you have not done so, and you are an accredited investor, sign up for our accredited investor club, because who doesn't want to join a club? And also, it's free, and it's an opportunity to basically take in some deal flow that's not available to the general public. Now, of course, you do need to be an accredited investor. You do need to get onboarded. So you basically sign up, you'll get some forms to fill out, and then you'll talk to some folks just to make sure you're appropriate as an accredited investor. And then we're off to the races. So anyway, check it out, wealthformula.com. Today, I am going to talk a little bit about gold again. Last week, we talked about this whole idea of a gold bond. And, we got another gold show. What can I say? My producers like gold. So do I like gold? Well, that's another question altogether. What I would say is this. When it comes to building wealth, I'm all about putting money into assets that actually work for you. Okay. So gold has been performing great this year, and we know that it's been a headliner, and it's got a certain allure, right? I mean, it's stable, it's shiny, and it stood the test of time as a safe haven, right? But to me, gold's appeal does have some limitations, and you know that if you've been listening to me for a while. I started out when I was first doing the show about a decade ago. I was like sort of in the gold bug zombie apocalypse camp. Which I've kind of come around and grown out of. My issues with gold are, for example, it doesn't generate income or adapt to a growing economy. It's really a static asset just sitting there. And it relies on scarcity, and it relies on market sentiment for value. And that's the reality. And you compare that to cash flowing real estate, which of course is, again, my primary interest. Cash flowing real estate actually earns rental income. It appreciates with time. And reinvests in itself. With real estate, your money is actually working hard for you. It's creating a compounding value, unlike gold, right? Which is, again, it just kind of sits there. It doesn't really do much. Of course, gold does shine during certain uncertainty, which is why people flock to it in market turmoil. But cash flowing assets like real estate can also perform steadily if they're managed properly. Now, the issues you may have encountered if you've been in real estate in times that it's gotten itself in trouble, they're always related to the leverage, right? It's not the real estate itself. So, if you take gold, and obviously you're not, I don't know anybody who really leverages gold. It wouldn't make any sense to do so. But say you took real estate and you didn't leverage real estate at all, it's essentially doing the same thing as gold, except now it's producing cash, right? So if you're concerned about some of those safety issues, it might make sense to have part of your real estate really low leverage or unleveraged altogether. I mean, then you've kind of got the best of what gold is offering, and you have cash flow. But listen, physical gold, it's tangible. It can feel reassuring, like you're holding real wealth, but it requires, secure storage and insurance, ongoing costs. Then there's ETFs. They're easier access. They're cost effective, but in really a true crisis, and that's what a lot of people are preparing for in gold, in the gold bugs, right? So a piece of paper representing gold might not be as good as the real thing. So both have pros and cons, but the bottom line is, whether it comes to physical gold or ETFs, neither produces income. Investing in real estate, on the other hand, it doesn't just store wealth, it creates it. You're part of the economy, providing essential spaces and earning rental income, all while property values grow. So real estate adapts, it reinvests, and it compounds, right? So again, gold doesn't do those things. In short, real estate really has the flexibility to evolve with the market, while gold's value remains static. And again, just to emphasize the point, gold isn't free to own. Physical gold comes with storage fees, insurance, and sometimes appraisal costs. Real estate has maintenance costs too, sure, but again, those are supposed to be offset by rental income. With gold, you're continuously paying without any return. It's a net cost, not an asset that actively pays you back. So, am I anti-gold? No, I just don't see it the way some people see it. I just don't understand why I wouldn't buy unleveraged real estate instead of gold. I just don't get it. Okay. But that being said, I will concede one thing. Gold has been around a long time and will continue to be in the future. And as a hedge against inflation, it has no doubt withstood the test of time. I've brought this up before, but I'll say it again. An ounce of gold in Roman times bought a guy a nice toga and a pair of sandals. And today, it'll buy you a really nice suit and a pair of shoes. And for that reason, you may still consider owning gold. I get it. So, in this week's episode of Wealth Formula Podcast, we're going to give you some guidance on how to do that. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Mark Yaxley. He's the CEO of Strategic Wealth Preservation. Mark's journey in the precious metals industry began in 2006 with Kitco Metals, culminating in the co-founding of SWP in the Cayman Islands in 2014. He's widely recognized for his impactful YouTube series, Inside the Vault. Mark, welcome to the program.
Hey, Buck. Thanks for having me.
So, obviously, you're a gold guy. So let's start with this. Like, what's going on with gold prices, man? How are these? How are gold prices outperforming expectations in 2024, and why do you think that is?
Yeah, for better or for worse, Buck, I've been a gold guy for the last 18 plus years.
Uh-huh.
Kind of stumbled my way into it and stuck with it. But, we're in a very, very interesting market at the moment. I mean, gold and silver now firing on all cylinders.
Mm-hmm.
Essentially, what it boils down to is you have all market participants on board and demanding gold and silver for that matter. So you've got the central banks who have been strong buyers since COVID broke out in 2020, which really kicked things off. And they've been the consistent player and factor that's been creating a floor for the price of gold.
Mm-hmm.
Then you've got the ETFs, which are right now net positive inflows. So ETFs represent a lot of money. That's Wall Street money. That's people that aren't necessarily what you would consider gold bugs. These aren't your kind of prepper, stodgy old guys who have always been loyal to gold and silver. These are people that see an opportunity, or funds that see an opportunity to capitalize on the price increases that we've seen. So they're now net positive throughout the world. You've got the North American, you've got the European, you've got the Far East. All of those ETFs right now are net positive inflow. And then we've got the retail market, those old loyal gold and silver buyers who probably add a little bit to their stack all the time. But you've got new retail buyers coming to the market, and that's helped by things like Costco. Costco's selling a ton of gold now, and that that's good. That's good for the market. So right now everybody's buying, and that's why the price is doing so well.
So tell me your take on the idea behind buying physical gold versus investing in, say, ETFs or GLD, whatever. Obviously, it sounds like you're more of a purist in terms of holding gold. So tell us a little bit about the difference in your view between holding gold in those different forms.
Yeah, I'm not, to be honest, I'm not a purist in the sense that I only advocate for physical ownership, nor do I only advocate for precious metal ownership in general. I think people need to have a diversified portfolio, stocks, crypto, real estate, gold and silver. You need to have it all. And so I'm certainly not a purist in that sense. But when it comes to owning metal, I think the argument between ETFs and physical kind of boils down to, for me anyways, it boils down to one thing is time. If I'm wanting to enter the market for a relatively short period of time because I see an opportunity or I have capital available to invest, let's say 60 days, I'm like, I've got cash for 60 days and then I'm going to roll it into something else. ETFs probably make a lot of sense because you cut out the premium of buying the physical product. You cut out any cost associated with delivering or storing it for a short period of time, and you can get out of the market very easy. ETFs, that's why they're so popular, is because they're very easy, right? It's very simple. You don't really have to know much about gold or silver. You're just like, oh, I can see it. I can buy it like a stock or a share, and I can get in and out of the market. It's great for that reason. The downside ETFs is that you do not actually own any personal property in that transaction. So if you're a large investor or large-ish investor and you're buying metal for a long period of time, one of your goals should be to reduce or remove all counterparty risk. ETFs come with more counterparty risk than physical metals do because when you buy physical metal, you own personal property, essentially. It's like buying a car, it's like buying a watch. You own something physical, and that is considered your personal property under the law. So if you kind of look at a broader time frame and you say, okay, I'm going to be investing in metals for the next 30 years of my life, and I want to reduce all counterparty risk, and it's going to cost me 4% more upfront. But if I annualize that over this long period of time, what's 4% over 30 years? It's nothing. It's inconsequential. Then you look at the management fees in an ETF. They do have management fees. A lot of people forget that. It's usually about 1%, 1.25%. Your storage fees for physical gold is probably going to be 0.5% to 1%. So you're actually saving money there. So things to consider, but usually it boils down to time frame for me.
Talk about the counterparty risk that you're worried about with a long-term investment. I mean, is there a precedent where all of a sudden, a gold ETF was not redeemed or was not worth what it was supposed to be worth? Is there precedence for that?
It's a really good question, actually. I can't say that there's precedent of a gold ETF failing that I'm aware of. What puts me a little bit on edge is the following. So I was on a long haul flight from North America to Europe. And I've been asked this question that you're asking today dozens of times over my career. And I'm like, you know what? I've got time. I'm going to dig into the ETFs today. And I read the terms and conditions, which is like 100 pages, which already is saying something when you got to read 100 pages of terms and conditions to get to the bottom of something. And what it really boiled down to, though, I found very interesting, is that the ETF itself is not responsible to custody the gold. They outsource the custody of the gold to a bank, a very large bank that everyone would recognize. In this particular case. A bank that I had personally audited when I was a younger man, and I started back in the early 2000s, and I went and did an audit in this bank in New York City. And we found all kinds of things in that audit, like things that should never happen in a gold audit. Anyways, but the point being that the gold actually was sitting in these bank vaults, and banks are excellent at leveraging assets that they have custody of. So they're going to start leasing, lending against these metals. They're going to use these metals as part of their portfolio to earn income, which they're entitled to if you read the terms and conditions and you agree to them. But as an owner of that underlying asset, or supposed owner of that underlying asset, that doesn't give me very much comfort. Not only the things I'd seen in that audit, but also the fact that that gold is being used at the benefit of the bank and not necessarily me, the guy who's buying shares in this ETF. So I found that very interesting.
So you're protecting against that somehow. That your concern is that somehow that could all fall apart and you'll end up with nothing. If you're holding like a GLD ETF or something like that.
I'm certainly not saying that you'll end up with nothing. I think that the GLD will always make good on their promises. What I'm saying is that you as an investor, if you're really just crunching numbers, if that's what it comes down to, and for a lot of people, that's what it comes down to. Are you really in a better situation by investing in GLD over a 30-year period than you would be buying physical metal and owning personal property, something that's tangible and that you have clear established ownership of? In a worst case scenario, I don't see the advantages over that long period of time. If you take the time to educate yourself and understand, which products I should buy and maybe where I should store it, I just don't see the advantage over a long period of time.
In terms of, maybe I just don't know the answer to this, but in terms of tax implications upon selling, if I sell GLD after 5 years, I assume I'm paying, what I would pay on any stock in terms of long-term capital gains. Whereas there's a different set of rules for selling physical gold, isn't there?
There is, and depending on which jurisdiction you live in, you're an American, a Canadian. If you live in the UK, has the best set of rules for physical ownership of gold. If you buy products from the Royal Mint of England, coins, gold coins or silver coins, and you sell those products in the future at a gain, there's no capital gains due. So if you live in the UK,
even for Americans, you're saying for Americans, they don't have to pay.
No, this is only for citizens of the UK. Okay. As an American, you have your capital gains on the ETF. You also have capital gains on the physical metal. The actual rates that you would pay, I don't know what they are, to be honest. I'm not a tax attorney or a tax accountant, so I can't give you those numbers, but I know that for a fact that you'd be paying capital gains on both of those investments. So
does gold end up being considered a collectible in this matter, though? Because collectibles generally, and again, I'm just trying to get the facts out here. I mean, anybody can go look it up, but taxation of GLD versus physical gold. I mean, is gold considered a collectible?
Some gold products would be, others would not be. For example, there are certain coins that are graded numismatic collectible coins. Very clear that they would be considered collectibles. But if you wanted to remove any doubt, let's put it this way: if you wanted to remove any doubt about a collectible versus non-collectible, and this is what I tend to recommend to our clients, anyways, is you would buy gold bullion bars. Gold bars save you premium over the long term versus coins, and would never are not considered collectibles under U.S. tax law.
Right. Anyway, yeah, I mean, I can clarify that for everybody. So you don't know. Bottom line is you don't know the difference in terms of the taxation between a long term hold of GLD versus physical gold.
I don't know the applicable tax rates. To be honest, we certainly don't strive to give tax advice.
Oh, it's not tax advice. I think it's just law, right? I mean, that's all you're looking at. You're not looking at tax advice, but at any rate, that's fine. Let's go into sort of like what's your take on like what's the best way to store the stuff then? And that's what you do, right? You store gold.
So one of the things we do, we do own and operate a large storage facility in the Cayman Islands. So we fall into the group of vault operators that are considered offshore. So offshore storage.
Okay.
We compete with markets like Zurich, Singapore, for example.
Okay.
Best place to store gold, some at home, definitely. There's some benefit to having some gold or silver in your own personal possession. Maybe your safe deposit box, although safe deposit boxes are uninsured, so that's not optimal for large holdings. But, if you're talking maybe 10 ounces, $25,000 in that range, sure. You could have a nice safe, securely bolted to the floor in your house and probably have some gold and silver in there. But once you get into the, 100,000 conversation plus, you should probably start thinking about a professional storage facility where you can store that. There's a lot of them in the domestic United States market. There's a lot of them in Canada as well. Very popular these days because a lot of people are starting to realize again that there's value there. But yeah, what it boils down to for more sophisticated, wealthy investors is they tend to diversify that risk over multiple jurisdictions, just as you would probably diversify your overall portfolio. It's the same concept with gold and silver storage.
So I presume these people who are storing things overseas, they're buying the gold overseas. They're not, these things are heavy and not easy to bring from one place to another.
Yeah, you can remove all, you can buy and sell gold throughout your life without ever touching it. As long as you're dealing with reputable dealers and storage facilities, they do all the heavy lifting for you. So you can purchase it. It can be as easy as the following. You can literally purchase it online, instruct it to be delivered to said vault. And one day down the road, when you've reached your selling point, you would just liquidate it and you'd receive a bank wire. You'd never actually see that gold or touch that gold, but it would physically move through the logistics, and supply chain and be delivered to that vault and then liquidated. So very possible to remove all that complication from your life.
How reliable is that?
There is an entire global industry that has been functioning for, people have been trading gold for 6,000 years. So it's one of the most mature markets in the world. Even during COVID, it was one of the few markets that supplied, in terms of supply chain breakdowns, everybody's talking about supply chain breakdowns. That didn't happen in our industry. People still delivered gold. People still, stored gold. It's very mature and it works really, really well. Companies like Brinks, Loomis, those are brand names that people are probably familiar with. They facilitate some of this with the transportation. They own vaults just like we do. But yeah, it's super.
I guess what I'm asking is, like, we've talked a lot about the risks, and it's all I totally get it. All the risks and the counterparty risks of ETFs and GLD, but yeah, gold has been around for 6,000 years, but the internet has not. And when you're doing things online, like, how do you know that you're dealing with a company that's going to do what it actually says that is going to happen on the screen?
Yeah, that is the best question to answer, to be honest, because like any market, you've got bad actors, and people need to be aware of that as a starting point in the conversation. So I'm glad you asked. But it's not difficult to identify companies that if a gold company has been in business, I would say, for 5 years plus, chances are they're doing it the right way, because you get sniffed out pretty quick. If you're taking orders for physical gold and you're not delivering, or you're not able to provide audit statements to your clients. In the case of storage, like for example, us, we have to provide third-party audit statements to our clients. So an auditor comes in, counts everything, and sends out these statements. If you can't do those things, you won't last in the business. You will get sniffed out, either by your industry colleagues or by the investors. So not difficult to find reputable dealers. There are tons of them in the US. There are a bunch of us offshore. And that is the best starting point. Identify those players that you can trust. And once you've got that, the rest is actually really easy. It's one of the simplest investments you'll make, to be honest.
Okay. How about silver? Same type of thing?
All the same general rules that apply to gold apply to silver in terms of the supply chain. Where does it come from? Who's producing the bars and coins? Who's delivering? Who's storing? Who's selling? All those things apply. The silver market, the silver price tends to follow gold. You're seeing that right now. Although it tends to outperform gold, both on the upside and downside. So it's more volatile than gold long term. And right now you're seeing the upside for silver, which, the other day it was up 6% a day, which is a lot for a commodity. And that's what people are witnessing right now. It's a great run for silver. Long term, as part of your overall portfolio, gold is the pillar that you're going to want to have there, because long term, it's obviously outperformed the price of silver. If you look at the cost per ounce, it's done a heck of a lot better than silver over the last 6,000 years. Yeah. But you definitely want to have some silver in your portfolio, because it's got a very diverse number of uses and different industrial applications, whereas gold has very few at this point in time.
From a practical standpoint, I'm just curious, if you have a bunch of gold bullion sitting around, or you have, like a monster box, silver, like, where do you sell it and get the best for your, the best possible price? Because obviously when you're selling this stuff, there's issues with, people are going to want it at a little bit of a discount. And how do you do that? It just as a retail person.
It actually depends on the product that you're selling, what you'll receive relative to the spot price. So like in the case of a monster box of silver eagle coins, for example, you actually get more than the spot price when you sell them. So of course there'll be a spread between what you paid your initial premium and what you get when you sell them. There will be a spread, and that's, talked earlier about like the 4% outlay. Yeah, you're going to have an outlay at some point, because you're buying a physical thing that was actually made and delivered to you. But it depends, to answer your question, it depends on the product that you're selling. Like the complications,
Okay.
Again, super easy to remove all that. If you establish a trusted dealer, a trusted storage provider, and those storage providers and dealers, in which case we actually are both, we have the hybrid model, they provide you the liquidity. So if you're like, hey, I want to sell my box of silver eagles today that's sitting in your vault in the Cayman Islands or Singapore or in Delaware, go ahead and do that. It's like, not a problem. We take the order, we quote you the price, you accept, send you wire. All that is super easy. It works really, really well. But if you decide to take home delivery, you got some more heavy lifting to do on your side.
Yeah, I'm just curious on that heavy lifting, though. I mean, is there a way? Like, I know people who, I have a box. I have a monster box I've had for, gosh, I don't know, 15 years. And if I wanted to sell it, I have no idea how I would even sell it.
No, I'm sorry to hear that. You should have 2 or 3 guys like me. You can just call.
Yeah, I guess. Anyway, it is what it is. So tell us more about your business.
More about our business. We
Yeah.
were founded in 2014, so we're coming up on our 10-year anniversary. We are headquartered in the Cayman Islands, which is really unique in our industry. We're the only physical dealer and vault operator in the Cayman Islands. We set it up there to cater to the US and Canadian market. A lot of those investors were going to Zurich. They were going to Singapore. Back in the day, they used to go to Hong Kong, but Hong Kong's fallen out of favor. And so we wanted to capture that market, and that's what we did. So we built the vault. We created the marketplace where we sell and buy metal within the vault. So like kind of explaining how easy that all is when it resides in one place. And we added 11 other locations now, 5 in the US, 2 in Canada. We do store in Zurich and Singapore. We just added Dubai as well. So, we go where demand is. And that's really the model. We're not a mass retailer. We don't try to compete with the guys who have advertisements on Fox or other news channels, the late night dealers. Those guys, it's a different model. We tend to cater to a bespoke client, mid to high net worth. Those are the type of people.
What's the advantage of working with you guys compared to them?
Biggest advantage, I would say, for American and Canadian clients is the fact that all your transactions are processed offshore. It gives you more privacy. The laws that apply to the US and Canada don't apply to a dealer in the Cayman Islands. So disclosure of information is limited. We do have a regulator in the Cayman Islands, of course, but we do not have to disclose any information to the IRS, for example, or to the CRA in Canada, which is an advantage for some clients, certainly. And we offer diversification. Again, we offer the opportunity to have some of your assets outside of the US, outside of Canada, which is hard to come by these days for a lot of people. So they tend to be pigeonholed a little bit depending on where they live.
Yeah. Okay. Well, and how do people get a hold of you?
Yeah, the website is great, swpcayman.com. It's very complete, a lot of information there, answers, a lot of the questions that we talked about today. You can also follow us on YouTube. We did the educational video series called Inside the Vault. It's like the 101 ABCs of precious metal ownership. It tackles all of these questions because it's really about education. Our industry struggles to educate people well.
Sure.
We need to do a better job of that. Yeah.
Thanks, Mark. I really appreciate it. And well, good luck to you.
Thanks, Buck. And if you ever need to sell that box, you just look me up. Take care.
All right, take care.
All right.
Be right back. Welcome back to the show, everyone. Hope you enjoyed it. And again, if you decide to own gold, here are some concepts that you might want to consider. Hopefully they were useful to you. One of the questions that people sometimes have for me is like, why are you so down on gold, but you are somebody who seems to really like Bitcoin? Well, that's a very good question, because in some respects, I think ultimately Bitcoin will end up where gold is as a storage of value type thing. Bitcoin doesn't cost me any money to hold, for one thing. I see Bitcoin as a very speculative play, because I think that to me, it's sort of like gold before, all the money came into gold, right? So I do think there's a tremendous growth opportunity for Bitcoin. And really, I look at it as a speculative asset that has a tremendous amount of upside based on, the adoption of Bitcoin as a commodity by the mainstream, which is clearly happening. So again, theoretically, over time, I would think Bitcoin would become similar to gold, and then maybe I don't own it anymore, right? By that time, there's not as much growth in Bitcoin. Maybe it becomes more less volatile and more more stable. But when it becomes that way, it becomes less attractive as an investment, because at that point, again, it doesn't really create any income. Hopefully that makes sense. But right now, I am much more likely to buy Bitcoin than I am gold. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.